Good afternoon, everyone. I think everybody is connected. It looks like audio is working for everyone. We always want to be mindful of your time in lunch clubs, so we are going to go ahead and get started. I am Gina Woodward. I'm the Regional Director of the Americas SBDC at West Texas A&M University, and I hope you're in the right place today if you're here to learn about what it takes to apply for a loan. You want a checklist for a loan application, you're definitely in the right place. Lunch clubs are monthly webinars that we do out of our office, and our goal with those lunch clubs is to really help you learn a new skill that can help you grow your business. I always tell my staff when we're working on workshops, there's just nothing that makes me madder than when I spend a whole day and I go to a workshop and they've done nothing but talk about something. I want to learn how to do something. And so that's what we're going to learn today. That checklist, you want to apply for a loan. What is it that you need to do? Just a second, I will introduce our speaker. He's got a lot more of experience in that area than I do. I'll tell you a little bit about the SBDC if you have never gotten to work with us. There's SBDCs all across the United States. We are funded by and a program of the U.S. Small Business Administration, but that's obviously a very large area to cover the whole United States. And so they contract with local, regional, and sometimes national universities to host those programs. The way I always explain it to people, I know that's a complicated relationship. If you've ever watched Big Bang Theory and you know Leonard and Sheldon are working on their research, they work for Caltech. Caltech is their boss, WT is my boss, but they are beholden to National Science Foundation for what they're doing. Same situation, I am beholden to SBA for what I do, but I work for West Texas A&M University where we entrepreneurs all across the Texas Panhandle. One of the wonderful things about the program is that we have SBDCs all across the United States. I am actually traveling today for a meeting and I'm sitting in a beautiful Midland office. So if you are not in the Panhandle, we absolutely have offices elsewhere that can help you. You can reach out afterwards. We get some additional funding. This is particularly important from a couple of partners. One of those being Capital CDC, and they've got offices all across Texas. You're about to meet Jason with CDC and learn about some of the great work that they do. What do we do at the SBDC? It really boils down to three different things. The main thing that we're doing all day is consulting. That's where we're working with you one-on-one to help you with your business. Might be cash flow projections, market research, business plans, strategic planning, whatever though the technical piece that you feel like you're missing in your business, that's where we're here to step in and help you out with that. That work is all free of charge thanks to funding from the SBA and partners like Capital CDC. We also do some training. That's why you are here today. And then we've got access to some really great research facilities where we can pull market and demographic information for your business planning. And then last piece that I want to mention, this is for our office in the Texas Panhandle. You can see in the top right, that's our staff at the SBDC Center in Amarillo. That staff is primarily working with clients in Amarillo and Canyon. Brand new to our office, Annie and Maricela. They are focused on working with clients in the Panhandle outside of Amarillo and Canyon. If that might be you, please let me know and I would be glad to make that introduction. Their services are also free of charge. Lunch clubs, if you've never been on one, we're very informal. We're here to learn. If you've got questions as we go, you are welcome to type them in the chat box and I will be watching that. In the end, once Jason's done with the presentation, I'll read off whatever it is in the chat, but you're also welcome to unmute yourself and speak up if you'd like to do so. Now I get to introduce our featured speaker today. Jason Bigham has been such a wonderful friend to the SBDC. Jason, I've been here for 16 years, and I am pretty sure that you have been here longer than me, but you've always been such a wonderful supporter of the program. Jason was born in Lubbock. He currently works in Lubbock. He moved to New Mexico for a little while, but we forgave him for that because he did come back to us in Texas. He's been involved in commercial lending for over 30 years. What we really asked Jason to do today was show us, maybe you're new to business, maybe this is the first time you've ever gotten to apply for a loan. What are the things that you need to be thinking about? What's that checklist that will help make you successful? So Jason, thank you so much for being here today.
Thank you. I'm glad to be here. I think I've started in Capital about 14 years ago. So but it was there were different people in your office back then, I guess. And so I've enjoyed working with you over the years as well. We'll go ahead and jump into presentation. Let me share my screen now. Boom. Does it look good? Everybody see this?
Perfect.
All right. So the purpose of this little webinar, a little lunch club, is to kind of go over what would be involved in a loan checklist. What you want to know, if you're putting together a list of the items that you're going to need to go get funding for your business, what are you going to need? That's what we're going to talk about today. Again, this is me. I am out of Lubbock, is where I'm headquartered. Our company is headquartered in Austin. And as Gina says, we have offices throughout Texas, also in New Mexico and Arkansas. We are a certified development corporation. That's what CDC stands for. That means that we administer loans under SBA's 504 loan program, which is administered by certified development corporations. We are a nonprofit. We're an economic development company in a way similar to the SBDC, but we're kind of out there working with borrowers directly, usually to finance larger fixed assets. We can go all the way up to $5.5 million loans that are part of, that are a chunk of even bigger projects, where it's not unusual for us to do even $20+ million projects in some cases. So, but we also do a lot of smaller things. So we're all the way throughout the whole spectrum of small business. So let's jump into it. So you've been thinking about an idea, whatever it might be. You might have an idea for a product that you want to build. You might have a restaurant idea that you think there's a space for in your town. You might have a store that you want to open, and you feel like, I can do this. I've seen it done. I have what it takes to run a business, but I'm not quite sure how to get started. Where do I begin? And the first thing is going to be a business plan. And I'm highlighting here that it's mandatory because it really is. There's an old cliche that says, if you fail to plan, you're planning to fail, right? And I'll try to keep the cliches to a minimum. But that's a good one here, because that's what a business plan represents, is that it's if you fail to come up with a business plan, then you're kind of planning to fail when you walk into a banker's office, because they're going to want to see it. And the better it is, the better it's going to represent you. I've listed the kind of things that you're going to want to include in your business plan here. Of course, most of it's self-explanatory, but we'll kind of go through it. The target market is, who are your primary customers? Where are they located? Of course, the products and services that you're going to be delivering. You want to include pricing along with that. Business operations means we want to know, how will the business generate and collect revenues? Are you going to be a retail store where it's just cash over the counter, basically? Or are you going to be more of a manufacturer where you're filling orders? Or maybe a contractor, a service provider, where you go and perform a service for someone and then bill them for the services and get paid maybe 30, 45, 60 days later. These are all ways that businesses operate. They're all legitimate. They're all okay. And the banks are used to seeing these types of operations and many more, but you need to be clear about it. If the answer is, well, how are you going to collect revenues? Or if the question is, how are you going to collect revenues? And your answer is, I don't know. How do you think I should collect revenues? Well, then the bank's going to think that you haven't really done your homework. So make sure that you cover that in your business plan. By the way, I've kind of skipped ahead without pointing out, of course, the place to go to get help for your business plan is the SBDC. It's true that people can come up with their own. And today on the internet and with the assistance of AI, you might even be able to put together a pretty good one. But the SBDC has people there with experience who have viewed dozens, hundreds, or thousands of business plans, and they'll be able to really give you some good advice, especially for your market. So make sure that that's where you go to get this mandatory business plan started. Sorry, I didn't mention that at the beginning. Moving on, you're going to want to tell in your business plan who your management and key personnel are. Just a brief summary of who the people are that are going to be running your business and what, if any, industry experience that they have, or what experience they do have that makes them right to be running the business. You'll need a marketing and sales plan. How will the business advertise? How's the business going to reach its target market? The industry and competitor analysis. This is kind of a thing that'll set you apart. Lots of businesses get started and they want to get started and they kind of don't know anything about their competitors. So this is really going to be helpful if you go and do some research. And again, the SBDC can help you with this. They have market research tools available in their shop, and they know how to help you get that information. It's even in this day and age of being able to search it, if you don't know the right questions to ask, it can be difficult to get the information you need. And the SBDC knows the right way to help you do that market research. And again, they're free, right? We're not really selling anything here. The SBDC is here to help people. We're here to help people. And, if we do that well, then we'll get to keep on helping people. But nobody's looking to charge you for this stuff. It's what they do. The next thing, and we're going to spend some more time on this, income projections or financials. Bank is going to expect a certain level of, I don't know if I'd say expertise, but familiarity with how a basic income statement would be put together for your business. What they're going to want to see, how much money do you think you're going to make? And then they're going to want to see financial statements that show what your current financial condition is now, not only for the business, but for you personally. And then you're going to need detailed assumptions. If you're going to sell a product, or whatever it is you're going to do, if you're going to sell, for example, we're going to want to know, how many items are you going to sell? How many jobs are you going to do if you're delivering services? How many widgets are you going to make if you're actually manufacturing a product? These are all things that are going to be dealt with in your business plan, and where the SBDC help you put that all together. So I want to talk a little bit more then about the idea of projections and show you this is actually what we use. It's a very simple spreadsheet, really. We're talking about 12 months plus an annual summary over here on the right, column N. This is just a snip from our actual spreadsheet that we give to borrowers where we need to see some projections, which for us is any project where it's a new location or a new business is going to be projections based. This is a real critical time, of course, in your business. This is how you get started. You got nothing else to go on. You have no history. Once you have that, you're going to find financing is going to be a lot easier for you to obtain. Once you've got a history and you can show, hey, we've been profitable for several years. Well, then your question is not going to be so much, where do I go to get financing? It's going to be, who do I choose to get financing? And you're going to be telling bankers no at that point, because you're already up and running. Everybody's going to want to be your baby when you have the business up and running and it's paying its bills. The trick is how to get to that point. So for now, you're a startup, you're projections based. So you need to spend some time on these projections. You see the list of assumptions down here on the lower left. We start up at the top. We're just talking about sales, COGS, which is an accounting term that stands for cost of goods sold. It's like, so you're selling the thing. What did that thing cost you to buy? That's cost of goods sold. And then that's your gross profit. and then you deduct your expenses. These are operating expenses, which are things that you're familiar with, of course, that you would imagine. Everybody knows that they're going to have to pay salaries for their business, right? That's one of the whole points of it. You're probably wanting to draw a salary from your business. You're probably going to have to pay for rent. There's going to be auto expense, other supplies that you need, some advertising, other things like that, utilities, taxes, licenses, repairs and maintenance, depreciation, which is another accounting term. And you may need help from an expert to determine that. Again, SBDC can give you guidance along those lines. Depreciation is a kind of a make-believe expense that is the government gives you the ability to, when your business buys assets, the government allows you to depreciate or take part of a fraction of the value of those assets as an expense every year in order to kind of make up for the fact that those assets will lose value over time, right? That's what we mean by depreciation, is the amount of value that's lost on assets that you own. And other expenses, all the way down to office expenses. There's other lines here you could add on to this for whatever is specific to your industry. And we don't know that, right? We don't know, from a doctor's office to a restaurant to a movie theater to a bowling alley, what is the right level of expenses. We kind of expect you to know that. But so this is a highly customizable spreadsheet. Be happy to provide this to Gina, and Gina can provide it to anybody as well. And these questions are down here. So this helps you put together projections. We want to see them in the first year. We want them to go month by month. So that's why we've got all 12 columns here. You would start in, it doesn't have to start in January, start in the first month that you're going to be open. So if your first month of operations is going to be August 2024, then that's what you put in month one, whoops. And then so on until you've got the first full year of operations. And then we want to see those actually for 2 years. So that's what projections are. And it's pretty important. The bank and any lender is going to want to know, how much money do you think you're going to make here? And why do you think that you're going to make that much? So that's what the projections and the assumptions are all about. I mentioned the bank will also want to know, they'll want to see some financial statements. What are financial statements? This is, as you continue in your development and career as a small business owner, you're going to want to know a little bit more about accounting. If you already have some background in accounting, that's going to be a big advantage for you. But it's not hard to get up to speed. In fact, again, SBDC is going to have resources. Sometimes it's hard, if you're working a job right now, it's tough to get down and make an appointment that works for everybody. If you need to do that, go to YouTube, do a quick search. I've done it for basic accounting principles for small business. Going to be a bunch of videos there that you can watch and get up to speed on the basics, which are really, you need to understand a balance sheet, what it is, what it means, and you need to understand an income statement, otherwise known as a profit and loss statement, those projections that I just showed you, that this is an example of a sort of income statement. But let's look at a couple of just fake accounting statements, the balance sheet and the income statement. And really, you can get up to speed on this. I'm going to be using some accounting terms, I guess, here. We're going to look at something that may seem familiar or may seem unfamiliar to you, but you can get a handle on this. It's fairly simple. Let's look at a balance sheet. This is just a balance sheet for an example company. I just pulled it off the internet. Balance sheet always has two sides. It's going to be on the left, it's going to be your assets. On the right, it's going to be liabilities, followed by equity. You've heard people referred to as, millionaires, multimillionaires, or that guy's worth $500 million, whatever. The net worth is a term that you'll hear a lot. Well, net worth is very simple. It's the value of your assets minus the value or the amount of your liabilities equals your net worth, right? So if you own $500,000 worth of stuff and you owe $200,000 against that stuff, then you have a net worth of $300,000. Simple. And it goes all the way up through, multi-billionaires. Well, let's look at this company. This company had very simple, and here's how a balance sheet works, by the way. On the left, you're going to see assets, as I mentioned. On the right, liabilities. It always starts with current assets, which are what's the most current asset is a dollar that you have in your hand, right? You can go spend that right now. And so that's the most current asset is cash. And then it gets to be less current from there. But cash, petty cash for this business, temporary investments, I don't even know what those might be. But then it accounts, so these are all cash that you have on hand. How much, and this will be an important one that we'll look at. How much cash does this guy have? Well, $2,200. That's how much cash he's got. What else? What are other assets does he have? Well, he's got 40,500 in accounts receivable. What's accounts receivable? Well, that's something that you've sold, but that you haven't been paid for yet. So if you're a contractor, it might be a job that you've done and you haven't been paid for yet. If you're a manufacturer, it could be $40,500 in product that you've shipped, but that hasn't been paid for yet. So that's an accounts receivable. As you would expect, on the other side, there's going to be accounts payable. We'll talk about that in a second. You also list as an asset any inventory that you have, what supplies you have, any prepaid insurance, which is that now we're getting kind of into an accounting, we're kind of getting to the weeds of accounting here. But you paid your insurance in advance for the year, and so that accounting rules allow you to book that as an asset on your balance sheet. You might not do that as you're just getting started, but as your business gets up and running, of course, you will want to have a relationship with a good accountant, at least a bookkeeper, if not a CPA, that will help you with these things. It's going to be worth the money, especially if you're not very familiar with accounting. You really want to make sure that you have good advice along those lines. This is a lifetime thing, right? It's a big commitment that you're making. So you want to be sure that you get that good advice. Also, assets. So we've got total current assets, 89,000, investments, 36,000. Now we've got long-term assets. Those include real estate, land improvements. That's just another word for building. In the valuation of real estate, land and the building are considered separately and together, but they're separate valuations. So that's not a very, land improvements. Improvements might be, landscaping, parking lot. And then you got the buildings, and then you've got equipment. And then there's been some depreciation over the years. So we've got $337,000 worth here of long-term assets. And then on this balance sheet, they're including what we call intangible assets. These are things that there's a value to them, but you're really not sure how it is, how much it is, or what to call it. Goodwill is the idea of what your good name is worth in the community. So for a business, when you start off, you got no goodwill because what do you have? Nobody's heard of your company before, so you wouldn't worry about anything like that. Trade names, etc. You might have had to purchase that. I think when you think of, you might not deal with these types of intangibles as a small business when you get started for many years, but it's something that is allowed to go on the balance sheet. You think about the value of something like the Nike logo or the Disney name, something like that, right? Coca-Cola. These are gigantic brands where there really is a value to the company, and it's worth some goodwill. It's worth some, we have a different name for it. We call it blue sky, which kind of means, well, we're not going to lend against that. We're not going to give you money for your blue sky because it's intangible. We can't, a tangible asset like cash or property. Well, if we get to a point where things don't quite go the way you expect, and the bank has to go back in and liquidate assets in order to pay its loan back, well, You can get assets, you can get cash, you can get land and buildings, but intangible stuff, you can't really foreclose on goodwill. Not that we want to worry too much about foreclosures, but it's you should know that, of course, banks are worried about foreclosures, and you should be cognizant of that. On the other side, liabilities, real quick, it's again the same thing. We go from current to long term. Notes payable are, notes that you expect to be paid on fairly quickly. Accounts payable, the opposite side of accounts receivable, that's bills that you've incurred that you haven't paid yet. Wages payable, interest payable, taxes payable. You don't always see on interim financial statements these kind of payable items, but they're legitimate accounting items. And then long-term liabilities, notes payable, bonds payable. You would also include this might include real estate loans. We would certainly expect to see real estate loans under long-term liabilities. So again, this company, 770,000 in total assets, minus 481,000 in liabilities. And then there's a way to break that up and include things like the value of, the equity is what we're talking about. Total stockholders' equity of 289,000. And then that's divided up these ways. Again, this is getting into the weeds a little bit from an accounting standpoint. You probably won't worry about those things. Mainly, here's what we own, here's what we owe. The difference is our net worth. The things that we focus on are, as lenders, are how much cash you got, what does your accounts receivable look like? Is it stretched out over a long time, or is it something that's, you can expect to receive all those within the next 3 months? What are your accounts payable look like, and what are your long-term liabilities? Because those tell us what your debt requirements are. All right, let's go on a little bit and move into the income statement. Generally, an income statement will be on, one column like this. What we saw before, this is kind of an income statement spread out over 12 months, but generally we'll see them for a certain period. This is for the accountant will say, this is for the 5 months ended on May 31, 2017. So we know that this is going to be 5 months worth of operating history for the company. So in the past 5 months, this company has experienced $100,000 worth of sales, minus 75,000 cost of goods sold, gross profit of 25,000, and it had these expenses, and which led to an operating income of 12,000 bucks, minus interest, other expenses that we call below the line. Oh, loss from a lawsuit. That's a bummer for them. And then we got total net income then of $18,000. So in the past 5 months, this company has made a profit of $18,000. So we focus a lot on that. We want to see what the trends are here with sales. We like to see that things are going up as we're looking at a business historically. And when we go back to the income statement, probably what we're going to want to see here for our projections is, you're going to start off month 1, probably going to be the lowest sales you'll ever have, right? And then you would expect that over months 2, 3, 4, 5, 6, 7, 8, all the way through the end of the year, it'll ramp up as you become more established and as your customer base grows. And so we apply that to these income statements or profit and loss statements by when we see those, because we compare them periodically. We compare year to year and period to period. We want to see hopefully an upward trend. That's what your lender wants to see. All right, so if you've got that all together and now you feel like you're ready, I've got a good business plan, my financials are in there, my projections look tight, I've answered questions to the best of my ability, the SBDC's helped me put together something nice. Okay, now what? Well, it's time to go see a lender. I think a good way to start this process is, do you know anybody? If you're maybe you've owned a business in the past, maybe a relative of yours owns a business and they bank with Interstate Bank in town. I'm going to mention banks in Amarillo that I've done more business with. So your cousin owns a business, or whoever, and they deal with Mark Mars over at Interstate Bank, and they have good things to say about him. Well, you call Mark, good dude, and he loves to help small businesses. So you would call Mark and said, hey, my cousin is so-and-so. He told me to give you a call. Can I come talk to you about my new business? That's simple as that. If you don't know anybody like that, Gina at her office has a list of local bankers. They will be able to help you, and you start with them. She knows, and their office knows the ones who are focused on helping small businesses. Some of them aren't. Some of them are doing other types of things. So you can get a list and start with that with them. And so you call and you make an appointment so that you can go and share your business plan and talk to them about your business, your vision for this business that you're going to build. There's one other thing that you should prepare and bring with you, and that is you need to prepare a personal financial statement. This is very important. The business plan is awesome, and you got to have it, as I've said over and over, but it's a story, right? It's a kind of a cynical way of looking at it, or of referring to it might be to say it's kind of smoke, right? You can't prove it. You can't prove that this is going to happen. This is what you think is going to happen based on the information that you've gathered. But the bank is going to want to get concrete, and they're going to want to know, how much money do you have? How much money are you ready to invest to make your vision happen? You're going to the bank probably for 80 to 85%, in some cases, maybe even up to 90% financing of your business. In other words, the vast majority of the money that's going to be needed. And when you think about it, right, it's the vast amount, the majority of the risk that's going to be taken on this project is going to be by the bank. And so they want to know that they've got a partner with a little bit of wherewithal. By that, I mean some assets to back up what they want to do, and that they're willing to risk to make the thing happen. So you're going to put together a personal financial statement. This is SBA's Form 413. So in the industry, we just say, well, what is a 413? You know, shoot me their 413, right? That's how we'll refer to it. You don't see it on here because I've just taken a snip. You don't see where the form is, but this is what it is. And this is actually very common of a format for a loan application. Freddie Mac has a Form 1003 that is similar to this, that you might have seen for a home loan. So this is, this shouldn't shake you up too much. You'll notice right here, excuse me, on the first page, and I will say this, when you fill out your personal financial statement, and by the way, does it have to be on a 413? No, you can do your own, but there's some basic information you want. Essentially, it goes back to the balance sheet. We're just looking for a personal version of the balance sheet with also some additional information about you personally. So I would say, please fill it out thoroughly. The version of this form that we have can be filled out electronically, so you don't have to fill it out by hand. You can type it in, and then you print it at the end and sign it. But so, you know, give them your name, your business phone, if you have one, or home phone, etc. Fill it out fairly completely. Tell them what kind of a business that you're starting here, in terms of what kind of entity. Are you going to form a corporation? Are you going to do an S corporation, which is a different kind of corporation, an LLC or a partnership, a sole proprietorship, which is just you? Whichever it is, identify it. And by the way, if that's bringing up questions, I'm going to point you back again to the SBDC. They're going to help you with that. I'm not really looking to kind of go over each entity. There's pluses and minuses to each one, depending upon what you're trying to do. You want to tell here, you know, what's the date of the financial statement, and you want to fill it out, and you see, oh, look, this is familiar. Assets on the left, liabilities on the right, and net worth at the bottom. That's really how this should go, is you fill out your assets. You start off with how much cash you have, and in checking accounts, and how much you have in savings accounts. This is really important. They're going to want to see this. And they're going to want to see that you've got at least a little bit, a chunk, right? Of may not be much in terms of the total project, but at least they want to see that you've got hopefully in that 20% or more range. And the more you have, the better it is, obviously. But they don't expect that you'll have it all, because if you're trying to get 800,000 in financing and you had $1 million sitting in your account, well, then you wouldn't really need them. But that's probably not the case. You've probably saved up some, and you know you're going to need some money to put down. You should look at the total amount of your project and try to come up with 20%. There are options if you can't come up with 20. We can go as high as 90% in some cases. In other words, you'd only need 10% down, but show how much cash you've got right here, and then amount of any retirement accounts. Perhaps you already are working at a different job and you've got a retirement account you're bringing with you. Any notes receivable, you loaned your brother-in-law $2,000 and he's going to have to pay you, and you put that there. The cash value of life insurance. This is a confusing thing. You may have a $500,000 term policy. That doesn't mean you put 500,000 here. Cash value is there's special types of life insurance called whole life that over time, as you pay into it, it will accumulate an actual value. That's what we're looking for here. The value of any stocks and bonds you own, real estate, you would put the value of your home here, cars, just estimate. And it, by the way, it refers to different sections you can see where you would actually go to other sections and fill those out and bring those balances forward, etc., till you got the total amount of your assets. Include the total amount of your liabilities. Same thing as we discussed before, current to long-term, from accounts payable to notes payable, any installment accounts, real estate loans, until you get to your total liabilities here. And basically you're going to take the total assets line minus the total liabilities line is your net worth. And then you add liabilities and net worth, and that should be the same as your assets. That's why we call it a balance sheet, by the way, because the bottom number on the left should equal and be balanced with the bottom number on the right. And then they're going to want some more information. What is your current income? Maybe you're starting this business on a part-time basis and you're going to keep your current job. So you'll put that information here. Also tell about any contingent liabilities. You know, if you got your kid has taken out some student loans and you're a guarantor on those, you'll need to include those here. And just fill out this form as in as detailed a manner as you can. This is section 1, which is used to just describe other income from this part, section 1, description of other income in section 1. Move to section 2, notes payable. Give details. Section 3, stocks and bonds to the extent that you can. Talk about any real estate that you own. We especially want to know what you owe against it. We'd like to know what you paid for it, and as well as what it's, so we ask for original cost here as well as its present market value. And you know, we want to know what the balance is on your mortgage and what your monthly payment is. So that this is all because we're going to use that as part of our underwriting process to determine whether or not we think that this business will be able to pay back the loans, or whether you personally will be able to live, right? We don't want to do a loan where there's not going to be, we can't reasonably assume that there's going to be enough money left over at the end of every month, enough profit to pay the bills of the business and of you personally. So it's two different things that we're looking at there, right? We don't expect you to work for free. We expect that you are in this to make a profit from the business and that you'll use that to pay your own bills. And so this information is useful for that. Sometimes, in fact, a lot of times we'll just get this first section filled out and they don't do the rest. We have to follow up and get that information later. And there's a third page of it. There's as you can see, again, electronic. We'll want you to sign it and date it. At the right time, you'll put in your social security number. We would have a secure place for you to upload that, or you know, you'll just hand it to your banker. Right. So this is important. So now you've got your business plan is finished and is ready to go. It's got good projections. and it's got a solid set of assumptions in there. You've explained how you've come up with your numbers, and then you've got a personal financial statement too. These will get you the attention of a banker. And what he's going to do, or she is going to, they're going to look at it pretty quickly, and they're going to start running numbers in their head, and they're going to apply a set of criteria. What are those criteria? Here they are. We call them in the lending business the 5 C's. Again, I'll stop for a second, take a breath. Are there any questions before I kind of move into this part?
Jason, I'll add a question about financial statements that I ran into with a client just a couple of weeks ago. He's got multiple businesses. When he started one of the businesses, he purchased a couple of assets just on his own before his entity was formal. So he still makes the payments with the business revenue, but the assets are under his personal name. Are those included on the personal financial statement?
I think it depends upon this is an important point. I'm glad you brought it up. An asset can't be on 2 different financial statements. Okay, so if you own the car, the business, it can't show up as an asset of the business. It either belongs to the business or belongs to you personally. And so, Gina, I think your question there, it could be either way. We can take it into consideration, because the truth is, the person is the small business, and the small business is the person in many, many cases, right? And the wealth of the individual is often tied up with the wealth of the business. And so you may not have all those things set aside. Maybe there are a couple of work trucks that the owner bought personally, and those loans are in his name, and he pays them personally. And he might include them here because he's paying for them personally, or maybe he just includes the loans over here because those are in his name, and so he figures, well, I got to include that, but he doesn't include the assets. And so you'd want to make sure that you're being consistent. If the small business owner, if the small business owns the assets, then make sure that they're on the small business balance sheet. But if the owner owns them, you could still put them there. Just make sure you don't include them on the personal. Am I making sense there?
Yep, that makes perfect sense. Thank
Yeah,
you.
you don't want to do, and sometimes we'll see it, and they'll be like, oh, we've got 3 trucks here, and then you're looking at the personal. Well, he's got 2 trucks here. Wait a second. One of there's 2 2020 Fords. Are those the same thing? And they'll figure, yeah, I included it in both because the loans are in my name, but they're used by the business. Well, as I said, an asset can't be necessarily, it can only be owned by one entity, unless it's like a fractional interest in the asset. Well, I own 50% of this real estate. Okay. But still, your 50% can't be shown on 2 separate things. It needs to be on one financial statement. So I would probably say, put it on the personal. If the loans are in your personal name, put it on the personal, but let us know that those are used for work, and then we'll make the appropriate adjustments.
Perfect. Thank you.
Okay. Let's talk about the 5 C's of credit. This is pretty important. Remember that when you go into a bank, their job is to do loans. They really want to do them, and they're hoping that someone comes in to see them that is a solid enough customer, that looks good enough that they can make a loan to them, that they can go and recommend a loan. And that's kind of how it works at the bank, is there's a hierarchy, right? It goes from the president of the bank, the honchos, all the way down to the lenders. And those lenders, their career advances by recommending to the loan committee that they do loans, and those loans ends up paying back. Everybody looks good. The lender looks good. The customer is awesome. As I explained before, you get to that point after you've paid back your loan and are coming for another loan, or now all of a sudden you don't have to ask. You'll be dodging banks calling you on the phone. You'll be like, oh, it's that dude again from that bank. I'm already dealing with a bank. I don't want to talk to this guy. But you're not there yet, and he's not there yet with you either, or she. And so you want to uh, understand what they're thinking. And so what they're thinking is, I want to put this together in such a way that it minimizes the risk to the bank, that it helps the small business accomplish what they need, and it helps me by doing a loan so that my career can advance and do well. But uh, if I recommend a loan and it goes bad, my career takes a step backwards. So they don't want to do that. So there's a tension there, and most bankers are incentivized in some way or another to do loans, right? Well, they all are. They're incentivized to do them. With some, that comes in the form of a monthly commission check. With others, it comes as an annual bonus. Others, it might come in the form of promotion, which would include a pay raise. There's different ways to look at this. Sometimes it's a combination. Usually it's a combination. But here's what they're looking at. All right, 5 C's. Character. What is character? It refers to the business owner's reputation and track record for repaying debts. Lenders are going to look at this through your credit history, your references, and your interactions. Gina, do you usually include a form for references in a business plan, or is that a separate thing?
Not a, I wouldn't call it references, but we'll have a section where we'll include, where they can list mentor or some kind of industry partner.
Good.
So sort of along that line.
Something like that. Now, if you're starting off and you're only looking for, a smaller amount, $50,000, $100,000, less than $200,000 to get it going, well, you're not a known quantity, probably. Right now, by all means, if your kid goes to school with a lender's kid, use that and look for a warm introduction, which again, Gina can help you get if you don't know any bankers. She'll refer people to you. And I would do the same thing. But they're going to want to know about your character. And if your business doesn't have a track record, the way that's going to happen is they're going to pull your credit, and they're going to look at it and see what it says. And the credit's going to say that this person has or has not done a good job of paying their bills, or has consistently done a good job, or has had issues in the past. Any former bankruptcies are going to show up. That doesn't necessarily kill you, but they're going to show up until I think it's 7 or 8 years it takes for a bankruptcy to go off your credit report. Things like that. Pulling credit is going to be an important thing. And the credit report, and I know Gina will have some teaching for you guys on this. Credit is going to include what we call a FICO score, which is just a score, usually in the 600 to 800 range, that kind of tells the bank and tells anybody looking at it generally where this person's credit is. What we want is something in the high 6s to 8s. If we start getting mid to low 6s, it starts to become problematic. That means that there's going to be issues, that maybe you've got on there that you haven't paid bills on time, or maybe that you had a couple charges charged off, something like that. This is not insurmountable, but it's good to know about it. And there's a lot of tools available these days for you to find out what your credit rating is. I recommend that you use those, get a feel for it. And if you're below 660 or 650, see what you can do to improve that. Sometimes you can go dispute a negative or a derogatory remark on your credit report. Sometimes you can write to the credit agency and say that was paid off years ago, or something like, there's things that you can do. Again, I think Gina and her group will be able to help you with that. But that's one of the first things that they're going to look at. And this is just a way that any person in the lending industry can get a feel for someone, is by looking at their FICO score. It's tough to overcome a really bad one, although we can. You may have like a mid 600s, but several of those are medical collections. Well, even SBA specifically and explicitly recognizes that medical collections should not necessarily be counted against someone, because it seems like these days you go see a doctor and then, you have a question about your bill, and 3 weeks later it's been referred to a collection agency. they're not communicative. They don't respond to you, and they just call a collection agent and send it to them because they just want to get a little cash and move forward. Well, that's predatory. It's not fair. It's not right. And the industry recognizes that. So if you have a few medical collections, we can work with that. But generally, you want your FICO to be in good shape, and you do that by paying your bills on time every month. Don't have late pays, which is over 30 days past due. Just don't do it. Don't take on a debt that you can't pay. But if you have, there's ways to work through it. All right. So that's what we're looking for. We're looking for a solid history of timely payments on that credit history. References are good to have too. Positive feedback from vendors, especially business references, right? Now, if you're just getting started, you don't know, but maybe you've, made your own cheesecake in the past, and now you're going to open a company that sells cheesecake to restaurants, and you might have, people who would be willing to testify to that. That's just something. It matters because, character is the number one C for a reason. They want to know that they're dealing with somebody that they can trust. And there's ways that you got to put that in, that ends up being put in writing. Capacity refers to the ability of the business to generate enough cash flow to repay the loan. So it involves evaluating the company's financial health and performance, but you're a startup, so you don't have that history. It's true, but this is where so they're going to look at those projections and say, and probably here's what they're going to do. They're going to look at those projections. They're going to say, all right, let's cut these by 20%. Let's say he's unable, or she is unable to start it up as quickly as she thinks. They're going to stress them, is what we call it. They're going to take a chunk off and see, okay, if they don't meet their pro formas, if the projections don't come true, will they still be able to possibly pay this loan? So that's what capacity is looking at. And of course, if your business is already up and running, then they're going to want to see, it goes like this basically. And I'm going to go to that one weird trick at the end, debt coverage ratio. But they're going to want to know that looking back, has this business been able to pay its bills? And would this business have been able to pay this loan off with the income they generated 2 or 3 or 4 years ago? And if so, then that's a good indication. Right. The third C, how are we doing? At 10 minutes. Third C is capital, money. In other words, right? That's what we're talking about when we're talking about capital. And it's the the money that owners have invested in the business. It can include not only cash, but also assets, right? If you are starting a business with that's going to make clothing, and you've already, for some reason you inherited, or you came to own a bunch of industrial sewing machines, that goes into the capital thing. That's part of that makes it easier for you to operate your business. It's also the equity. It's the money that you've already invested in the business, as well as the money you've got available to invest. Then there's collateral. Loans are made without collateral, but most of the time there needs to be something there. Not always, but most of the time. Collateral is any asset that can be pledged to secure the loan, so that if the business fails to repay, the lender can seize the collateral to recover as much as possible of the loan amount. If your business is up and running, you're much more likely to have collateral. Again, for a startup, you're not going to have collateral, but it might be the property that you're buying. If your startup needs a new piece of real estate, and you can buy a building, that's part of what you need. You're going to buy a new building for $300,000. Well, that becomes collateral for the loan. Collateral is something that the lender has a legal right to go take if you don't fulfill the obligations of your loan covenants with them. So it's something you got to own. You can't put up collateral that is owned by somebody else. Hey, can I put up? Well, okay. Could you? My dad has a farm, and it's out there, and he's willing to put that up as collateral for my loan. Well, that might, if the value is significant, that may get your loan approved right there. But take it seriously, because it could mean that if the business fails, the lender will be coming to get that. So you can sometimes use non-project collateral or collateral that's outside the project, but it's best for the business to, of course, be able to use collateral assets that it already owns or the assets that it's purchasing. This reduces, it's a way of, all of these C's are ways to reduce the lender's risk. And then finally, conditions. What are the overall, what condition, economic environment and specific conditions for this loan? We have all seen the economy get crazy in the last 5 years, as we were in 18 and 19, and we're blowing and going in a lot of ways. And then 20 happens, COVID, and all of a sudden, whoa, everything changes. What are the conditions? The conditions, I can tell you that right now, the conditions for starting a new hotel in Amarillo, pretty good. 3 years ago, not that good, right? 2020 especially, terrible. We would not have done it. That's a simple way to look at it. But you need to show them with your business plan that, again, because the lender, they may have financed other businesses like yours, but generally they're not an expert on your type of business. You are. They're waiting. They want you to be, and they're going to make a bet on you. And so they want you to show them that the conditions are right, that there's a reason. You do that with your analysis of competitors and with your market analysis to show that, hey, there's nobody in town that's doing what I'm doing, that's going to bring what I'm bringing to the table, and show them that the conditions are right for that. All right. Finally, debt coverage ratio. This is going to be the number that they come up with in order to, at the end, they want to know that you're making enough money. And that's really all this means. Debt coverage ratio means how much more money are you making than you need to pay your debts. Specifically, they'll look at this several different ways. They'll look at it individually on the business side, and they'll look at it globally, which includes you personally and all your personal debts, all your personal living expenses. But the simplest way is just to look at the business. And what we have a minimum. Now on the SBA side, the minimum is 1-to-1. Okay, what are you talking about? What I mean is, we want you to be, if you've got 100,000 in debt service, we want you to be making $100,000 in profit after income and all your expenses before, except for taxes and depreciation, are paid. EBITDA is one way to refer to that. Earnings before income, taxes, depreciation, and amortization. That's how much, that's real. It's kind of a real number. Some might call that net operating income or net income, net profit. They'll use different, depending upon the shop, they may use different terms. But what we're talking about is that income that's left over after those expenses, but before taxes and depreciation and amortization. So if that money, if there's a 1-to-1 basis between that, you're technically eligible for an SBA loan. However, each SBA lender is required to exercise prudent lending standards, which we do. And so what we want to see is a ratio of about 1.25. In other words, we want you to be making, if you've got $100,000 in debt service, right? That's what I mean by the total of all your loan payments. That's your debt service. If you have $100,000 in debt service every year, you need to be making, the business needs to be making 125. If you come up short than that, we have to start looking at other areas. It's not as strong. We're fighting an uphill battle there. We sometimes can do that and win that, but what we want to see is that you're making enough. 1.1, probably some banks will work with that, depending upon the other factors, like how much collateral you may have, and how much cash you've got. If you've got extra cash, they'll let you slide a little bit on that debt coverage ratio because they know you've got the cash to make up for it until you get on more solid footing. But 125, 150, now we're talking. You've got $100,000 in debt service, but you're making 50,000. But you're making 150. So that's 50,000 left over. That's great. That's a solid loan, and the bank will make that loan. It really all kind of comes down to that, and it's just a risk question. These are methods and tools that the bank uses to quantify risk and to decide whether they want to take a chance on you. Now, it's true, you want to, of course, when you go see your banker, you want to, present yourself well. I don't think that suit and tie is necessary, and unless that's your type of business, right? If you're going to be an insurance agent, then you probably look, trying to go look like a successful insurance agent when you show up to the bank. But remember that that character is going to kind of come down. The credit report is one thing, but it's also, you want to make a good impression. You want to show them that you know what you're talking about and that you represent a good risk. And they really will be willing to make decisions on behalf of people that they trust and feel good about, more readily than they will people that they don't for whatever reason. Also, a lot of lenders have a certain level of authority. They might be able to lend themselves up to 200,000, but they got to go to loan committee for anything less than from 200 to $1 million or more. Those are just examples I'm just pulling out of the air. But you want them to, and so your guy may be able to make the decision right there, or your gal that you meet with, she may say, yeah, I think this is a good deal, and may be able to make a decision quickly once she's able to verify a few things. So just depending upon where you're at, preparation is key. Again, that cliche. If you fail to come up with a business plan, you're planning for your business to fail. You're planning to really not even get off the ground. Got to have it. Got to go in there knowing what you're talking about and coming off like an expert. And that will go a long way. Look, let's talk real quick about loan options and terms. I didn't want to go into too much detail on this. There's a lot of ways to do this. It depends upon what the asset is that's being financed. You know how when you get a home loan, it's usually for 30 years, right? But if you get a car loan, it's only for 5, 6, or maybe 7. That's because home loans are long-term assets and they have a lot of intrinsic value. Homes are, excuse me. So the value of a home is going to stay fairly consistent. Depreciation on a home is only, it's fractional. It takes a long time to depreciate real estate. So they know that it's a long-term asset. Therefore, you can get a 30-year loan, a long-term loan to finance that. Short-term assets like cars, well, a lot of cars get pretty beat up, especially a new one. And that first 5 to 7 years. After 7 years, it's not going to be worth much. So you get a short-term loan when you're financing a car. Well, it works the same way in small business finance. If you're financing real estate, you're going to be more likely to get long-term loans, at least 15 years, if not 20 or 25. Our company does loans on a 25 or 10, 20, or 25 years. Almost all real estate loans are done for 25. Your loan term refers to how quickly is your loan going to have to be repaid. You might say, well, what, I thought most home loans are 30 due in 30. But sometimes there's something we call a bullet or a balloon, which means that there's a balloon payment. So you might make 10 years of payments and then there's a balloon payment, meaning you have to repay the whole loan at that time. Know what that is and understand, of course, how that affects your situation. Amortization, that's kind of what I'm talking about in terms of the loan term. And I kind of skipped over loan to value here. If you've got an asset that's $100,000 and you're putting 20,000 down and borrowing 80, that's 80% loan to value. Pretty simple, right? Well, the only place you can get 90% loan to value on most small business real estate is through our program, the 504. Most of the time businesses are going to want, and most of the time lenders are going to want at least 15 or not, if not 20% down for new ventures. And for us, it goes up if the real estate is considered special use or if it's a new business. So, but loan to value is an important thing. And a bank will, of course, look at a 70% loan to value project differently than they would one that's at 85 or 90. That's the higher the loan to value is, the more risk there is for the bank. And then your rate, A lot of banks are going to be basing their rate on prime. Some banks base them on other measures like treasuries. Right now, prime's at 8.5. Banks will often price at 1 over prime, which means 9.5%. It also means it'll probably adjust. If they're pricing it over prime, it'll adjust during the term. It's adjustable rate loan. Lastly, guarantee. I mentioned it a little bit before. When you put up a guarantee, that means you're promising to repay and that you're putting up your personal assets. Now, Texas has special rules for homesteads, where I don't think homesteads, if your home is a homestead, the lender can't necessarily foreclose against that. But they can get everything else, like your car and other assets that you pledge as security for the loan. Your dad's farm, if that was one of the things that was put up. A personal guarantee means a personal promise to repay, even if you have to start selling off personal assets to do it. The opposite of a guarantee is something we don't see a lot in Texas. It's what we call a non-recourse loan, which would just mean that the only security for the loan is going to be the property that was put up. We don't really do that here because Texas is more of a full guarantee, full recourse state. All right, I've kind of exceeded my time here. Sorry about that, y'all. I do see that there were some questions. Were there some questions?
There are 2 questions. While you answer those, I'm gonna pop up
Sorry about that, Gina. I kind of kept going, didn't I?
Well, it was good information though, so thank you. The first question is Capital CDC participating in the SBA's pilot program, their new working capital program?
Okay. Are we giving loans part of SBA's working capital pilot program? I don't think we would under the Community Advantage Loan Program. We do some SBA loans under we do mostly 504, but we also do some what we call 7A loans under the Community Advantage Loan Program. I think for that one, you might have a better source for that. Gina says our company was accepted in the Texas Tech Business Accelerator Program 2024 cohort. Do you have a working relationship with that program? I don't. Texas Tech runs or funds the SBDC here in Lubbock, just like West Texas A&M does in Amarillo. And we have a good relationship with the SBDC here in town. If we can be helpful to you, we'd certainly be happy to do that. I don't need a special relationship to pick up the phone quickly when the SBDC calls. We want to help. Or I guess we just do have a relationship with the SBDC. I don't know specifically about the Business Accelerator Program 2024 cohort, but it would be, make me very happy to try to help anyone that was involved in a program like that. So I've got, you've got a special relationship with me. You can call me and I'll be happy to help you in any way that I can.
Absolutely. And you've all got Jason's contact email in the chat as well as ours. And then tomorrow you will all receive a follow-up email. It'll have a copy of the recording so you can go back and check out anything that you missed, and it'll have Jason's contact information in there again. If there are any other questions that come up after the webinar, you are always welcome to email either one of us. We'll make sure that those get over to Jason. Jason, thank you so much for this information. As you and I were talking about before we went live, these are the questions that we get most often, and it's both from startups and existing businesses. So I really appreciate you taking the time to do this today, and I appreciate all of you taking the time.
Yeah, it's been my pleasure, and I'll be happy to help. If anybody has any questions, just give me a call. And you're in good hands with the SBDC as well. We really do want to help you, and we really, it's a lot of fun working on these small businesses. I love to be able to go into a business that I help finance, whatever it might be. And we've done a lot of them in Amarillo. We've done a lot here in Lubbock. It's just a real pleasure to eat in a restaurant, that I help finance. It's awesome to see those things get up and going, and it's a great job that I get to do here as part of our economic development company. But just let us know if there's anything I can do to help.
You get to impact people on a very personal level. It's very rewarding.
Yeah, it's a lot of fun.
It is. Well, with that, happy Wednesday, everyone, and keep an eye out for that email tomorrow. Thank you, Jason.
Thanks. Yeah, thanks y'all for hanging in. Sorry I went over. Thank you. Bye.
Thank you.